Okay, let's talk about one of the most frustrating things in trading. That feeling, that moment when you are absolutely convinced the market is out to get you, personally. You know exactly what I'm talking about. You've done the work, you've set a perfect stop loss right below a key level, and then you just watch as the price spikes down, hits you, takes you out of the trade, and then boom, it rockets in the exact direction you knew it would go. It is absolutely infuriating.
But what if I told you this isn't random, that it's not bad luck at all? What if it's a predictable, repeatable, and totally intentional part of how the market works? It actually has a name, and the big institutions, well, they use it every single day.
And that's exactly what we're going to do here. By the time we're done, you're not just going to understand what this is. You're going to see it coming, you'll learn how to spot it in real time, and here's the best part, you'll learn how to flip the script and use it to your own advantage.
So, to really get this, we need to kind of shift our thinking. We're not just looking at charts here, we're watching a game unfold. It's the liquidity game, and these so called stop hunts are one of the most important moves on the board.
And this is where that shift in perspective is so important. See, for us retail traders, liquidity is just about how easily we can get in and out of a trade. But for institutions, it's a resource. It's the fuel they need to fill these massive orders without sending the price haywire. And where's the biggest source of that fuel? You guessed it, in these giant pools of our stop-loss orders. This right here, this gets to the heart of the motive. An institution can't just click buy on a position worth hundreds of millions of dollars. They need sellers on the other side. So what do? They engineer a price move to a place where they know thousands of stop-loss orders are sitting and waiting. They literally hunt for these pools to fill their own books. And that brings us to our main term, the liquidity sweep, or, as many people call it, a stop hunt. It is that deliberate action of price just piercing a key level, triggering all those stops, grabbing that liquidity, and then snapping right back in the other direction. Think of it like a quick raid, not a genuine move.
So, if these big institutions are actively hunting for liquidity pools, it makes sense that these pools form in very predictable places, right? So let's break down exactly where you need to be watching on your charts.
These are basically magnets for stop-loss orders. The most obvious ones are recent swing points, the clear peaks and valleys on your chart. Then you've got equal highs or lows, what most people call double or triple tops and bottoms. Those are practically screaming liquidity right here. And of course, don't forget those nice clean trend lines or big psychological round numbers. Basically, any place that looks like a super obvious spot to place a stop probably is. Okay, but this is the million-dollar question, isn't it? Knowing where the pools are is one thing. But how in the world do you tell the difference between a quick raid for fuel and the actual start of a brand new trend? Well, the secret is in the anatomy of the candlestick itself. The crucial difference is all in the candle. With a liquidity sweep, you'll see a long wick stab right through the level, but the candle body, the real meat of the move, it closes back inside the range. It's a clear rejection. A real breakout, on the other hand, closes its body confidently beyond that level. It'll often pause for a bit, consolidate, and then keep going. One is a grab and go, the other is a real move with serious intent. So let's just boil it down to two essential signals you need to look for. First, you've got the wick. That's the evidence of the raid. Second, you look for the reaction. A real sweep is almost always followed by a swift, powerful move back in the opposite direction. A lot of times it's an engulfing candle that totally wipes out the previous one. The raid is over, and now the real move is starting. All right, we've talked about the what, the why, and the where. Now, for the most important part, how do we turn all this knowledge into an actual trading strategy? It's time to stop being the one getting swept and start being the one who's profiting from it. And it really can be this straightforward. First, you do your homework. You mark out those obvious liquidity zones on your chart way before the price even gets there. Second, and this is key, you wait patiently for the sweep to happen and for that strong confirmation candle to close. Don't jump the gun. And third, once you have that confirmation, you execute your trade and you place your own stop loss safely on the other side of that long wick. Now here's a little pro tip to give you an extra edge. These moves, they need a lot of volume to work. And that's why the most powerful and reliable sweeps almost always happen during the busiest market hours. We're talking the London Open, the New York Open, or that sweet spot where they overlap. That's when the big players are most active. And always remember that context is king. A sweep of a major daily low carries so much more weight than a tiny sweep on a 1-minute chart. The higher the time frame, the bigger the liquidity pool, and the more powerful that potential reversal is going to be.
So, we've covered a ton of ground here, right? From understanding why institutions do what they do, all the way to building a simple trading plan around their actions. It really all comes down to a fundamental shift in how you see the market. So, let's just quickly recap the big points. Stop hunts aren't personal attacks, they're just methodical fuel stops for the big guys. You know exactly where to look for them, those obvious highs, lows, and trend lines. You know exactly what to look for, that long wick of the sweep followed by the strong body of the reversal, and now you have a simple plan to act on it.
By understanding this one concept, you're just not playing the same game as everybody else anymore. You're now looking at the market through the same lens as the institutions that actually move it. So the only question left to ask is, what are you going to do with this knowledge? Will you be the hunter or the hunted?